February 18th, 2026. SharonAI Holdings begins trading on Nasdaq at $30 a share. 4 weeks later, they announce a $1.25 billion AI infrastructure deal in Australia. The company's last reported revenue, $1.48 million. Their net income, negative $8.17 million. To put that in perspective, they just signed a contract worth 844 times their annual revenue. This isn't a story about an AI boom. It's a story about what happens when everyone stops asking to see the servers. Here's what the smart money saw. AI infrastructure is the hottest trade on the planet. Every data center announcement sends stocks soaring. Memory chip makers are shifting production away from smartphones entirely, prioritizing high bandwidth DDR5 for AI compute over consumer electronics. Samsung, SK Hynix, Micron, they're all making the same bet. The numbers back them up. IDC projected smartphone shipments would fall 12.9% in 2026, the sharpest decline on record. TrendForce went further. Global smartphone output down at least 10%, dropping to 1.135 billion units. Memory prices skyrocketing so fast that analysts predicted the entire sub-$500 PC segment would disappear by 2028. Translation: AI was eating the world's chip supply. And if you could land an AI infrastructure contract, real servers, real chips, real data centers, you were printing money. So when SharonAI Holdings announced a $1.25 billion deal in Australia on March 22nd, the headline wrote itself. Unknown player secures massive AI contract at the exact moment chip demand hits critical mass. But here's where it gets strange, because 4 months earlier, this same company had filed a document with the SEC that nobody seemed to read. December 17th, 2025, 2 months before their IPO, SharonAI entered into convertible promissory notes with 3 accredited investors. They borrowed $2.25 million at 10% annual interest, with a maturity date attached. That's not infrastructure funding, that's bridge financing. The kind you take when you need to keep the lights on. Now look at the IPO itself. February 18th, they priced at $30 per share, raising approximately $125 million in gross proceeds. Shares opened at $30.24, barely moved. No pop, no investor frenzy, just a flat open on what should have been a breakout AI infrastructure story. And this is the part nobody talks about. Their last reported financials showed total revenue of $1.48 million. Cost of revenue, $1.47 million. Gross profit, $8,300. Other expenses, $8.18 million. They were burning cash faster than they could generate it by a factor of nearly 1,000 to 1. Then, 1 month later, they announced the Australia deal. $1.25 billion. The press release used terms like neocloud and AI compute. At a Red Chip conference, CEO Brett Manning said having in-demand chips online provides pricing advantages given demand exceeding supply. He mentioned deployment timelines, 10 to 16 weeks once equipment is ordered. Here's what everyone missed. He never said they owned the chips. He never said they'd ordered the chips. He said once equipment is ordered, future tense, and he emphasized that investor understanding over the next 12 to 18 months would be driven by large customer contracts, not revenue, not deployed infrastructure, contracts. But that's not even the most interesting part. Go back to the prospectus filed with the SEC. The company formed through a reverse merger with Roth CH Acquisition Corp. report for a SPAC. Their pro forma balance sheet showed negative working capital. And buried in the risk factors, typical boilerplate about operational uncertainty, reliance on third-party partnerships, and the need for additional capital. This is where it stops being a coincidence. The trap has a name, narrative arbitrage. When hype moves faster than verification, the market prices the story, not the spreadsheet. AI infrastructure deals work like this in 2026. You announce a partnership, file an 8K, issue a press release with the word billion. Retail traders see the headline, check the ticker, see AI in the description. The stock moves. Nobody asks if the servers exist, because asking feels like missing the trade. It's the same pattern that caught investors in Nikola's hydrogen trucks, Lordstown's electric vans, and a dozen SPACs that announced partnerships with Fortune 500 companies they couldn't name. The deal always sounds real until someone asks where the equipment is. And here's the part that should actually scare you. If SharonAI's chips don't exist yet, and memory costs are already crushing the smartphone market at 31% year-over-year declines, where exactly is the capital coming from to buy them? March 2026. The AI boom is real. The chip shortage is real. The $1.25 billion headline is real. But here's the line worth remembering. In a market where demand exceeds supply, the winners aren't the ones who announce the biggest deals. They're the ones who already own the chips. SharonAI raised $125 million, borrowed $2.25 million to survive until the IPO, and reported $8,300 in gross profit last quarter. Now they're promising to deploy $1 billion in infrastructure in 10 to 16 weeks. The market isn't a machine for pricing companies. It's a machine for transferring money from people who read headlines to people who read footnotes.